Is is Fly a stock to own? Before I go into it, if you don't mind clicking the subscribe or give it a like after the video, I really appreciate it. That's really helped me to reach my YouTube account into the next level when I get enough people and enough viewers to watch my video. For those who have followed me, you probably know who I am. My name is Sam Wong. I graduated from a finance degree from the University of Houston. I worked over 10 years of experience in manufacturing energy companies, and lately I've been working with quite a bit of applications and be a system support and consultant. Unfortunately, I was laid off due to the pandemic a few months ago, so I am actually looking for jobs, and hopefully in 2021 will be a good year, and it'll be much easier to find the jobs. So let's talk about this real quick. So with four companies having vaccine effective rate over 70% and having PDA emergency use approval, airline, cruise, restaurant stock have already gone up over 20% lately. And this stock has set up a little later, but started moving as well. So in November, this stock was $6, but over a week and move up $2, $8, and then now recently have reached out to intraday high of 10.25. So let me give you a little background about what Fly Leasing Limited Company is. Fly Leasing Company is not a large cap stock, so it tends to have lack of coverage and more opportunity for mispricing. It is an aircraft leasing investment company. Its fleet comprises 110 aircraft, mostly Airbus A320 and Boeing 737 aircraft. So as you know, Boeing 737 already we take off again. So the opportunity for this company as well start leasing those to the airline company. FLY does not manage its own fleet. Instead, leasings are managed and executed by BBAM, a leasing management firm. So actually, I kind of like this type of business model where you don't really need a lot of costs, right, associated with, but just management fees, and then it will help you to find the people with contracts and needed, which have probably a sophisticated allocation system, and contract already signed it in a way with different airline companies. When it's needed, they will fill out the space so that they can be able to fulfill the requirement of passengers to be able to fly everywhere. As you know that, this year have been pandemic, so obviously, flight leasing is similar to other airline company or retails or these or restaurants that could beat up pretty badly. At September 30, 2020, Fly had 86 aircraft and 7 engines in its portfolio. Fly's current aircraft and engines are on lease to 39 airlines in 24 countries. Again, we can look at the graph pretty quick, and the good thing about this company too is there quite a bit of hedge fund owning it, and the third quarter hedge fund 7 were bullish on the stock. Mangrove Partners was the largest holder with a stake worth of 5.2 million. So we can look at the 2-year graph now, and you can see, as I explained to you in the pre-pandemic, the stock, which obviously this is because of the pandemic, was up on here around $20. So the business was actually, this is similar to other airline stock, was beat up pretty badly, and then lately you see a big jump since November. It will kind of pick it up, and this stock is still forecasted to have a $1.70 dollar per earning per share next year, which is this year 2021. The earning per share is positive in stock, which is good, $3.71. It had a great operating profit margin of 58.76%, much higher than similar industry trading company and distributor industry. While this stock are compared not with the airline industry, since this is kind of doing an operating and leasing business, so it's get it compared to trading company and distributor industry. Just want to give that for your understanding when we look at some of the information. So P/E ratio again is also pretty good. P/E ratio is at 2.21, which is very, very amazing. And the earnings, if you look at it, they have been doing pretty consistent earning pretty well. The financial statement and the balance sheet, if you look at it, you actually have a growth to 2019, and income statement have been very, very, very good since 2017. You have growing up since then, and then the cash flow also have been running very amazingly. And the other good attractive part about this stock too, like earnings the last quarter bit of 8%, which is good, is the book value were actually pretty low. So they only have 0. If we look at the valuations, there's some field highlight on the valuation. The price book ratio is only 0.34x. It really meaning that in terms of the price compared to book value, this stock is severely undervalued, which have a really great opportunity if the stock go back up, right? But you think about it, I mean, if you this probably not at the latest ratio calculation around $8 to use to compute that, so that means the stock technically at 1:1 ratio, it will be worth $30 this stock, right? And you can see people them at $20. So it's a very good, it's a very serious discounted company, right? And the percent held by institution currently 46.67%. So it wasn't, and income statement again, if you go back to this one income statement, it has actually shown you that it was really good and gone up year over year since 2017, and it was strong financial statement built up that leaving them to have a really good strong cash flow position. And analysts actual price varies, but on the average this stock they think about $13. So currently at 9.50. So if you think about the percentage of return from that perspective, it really give you really good ground. If you hit $15, you're talking about over 50% return. And also the other point is the price from a growth perspective, the price to book the price to EBV ratio is less than 1.1, which was really good. Less than 1.1, which is really good. That means the market participating that whatever the expectation, which is probably decline of the earnings on 2021, since it was still first of the year will be probably challenging the first 2 quarters of the year, and some projection of the airline industry would not be returned to normal before pandemic volume until 2024. So obviously they have kind of make their estimate lower for the outlook on the 2021-2022, but still a very attractive and because of that they're already pricing the value valuated and that at the moment. So this kind of saying the price is pretty good to leave some potential of the growth. And then the P/E ratio also very good, 2.65 compared to peers. This is compared to a peers Air Lease and other leasing corporations. You can see the number I like about which company Air Leasing is a much larger company. So, but then the highlight is the beta was actually lower than compared to Air Leasing. The P/E ratio is also way lower than them, and the profit margin is very similar to Air Leasing, where Air Leasing have a much larger revenue and it's a much larger company, but the profit margin percentage wise they actually relatively close to them. So that is giving some you kind of argue that that's giving a pretty good competitive advantage. So and then why the price was sour recently is there was like kind of rumor saying the company may sell the company may actually sell it, so it won't be public lease anymore. So because of that, if you look at the valuation perspective, the stock will be worth $30. So if they really sell something and find the right attractive customers, or maybe maybe United Airlines buy them, or who knows, then the potential what you're worth now $8, $9 will be worth $15 or $20, right? When the deal was made. So this is also part of the reason. What I'm a little disappointed is the growth of the company. But potentially, like I said, if the vaccine roll out this year, and start to get vaccinated, things will back to normal in this year, June, or maybe third quarter, or later this year, third quarter, then this company actually will probably beat estimate and things are pretty well. So those are the really major reason I really picked this stock and I think the earning per share will slip because of pandemic, but should be recovered slowly in the following years, and the projection of better revenue with constant debt level, and they have a really strong cash flow. So. I think this is a good buying point now, around $9-ish, and you will go up to 13.50 in my opinion. But you could actually easily hit above that if you beat the estimate, go to $15. If you like this video, please give me a like. If you have any comments, please feel free to drop it down in the YouTube as well. Have a nice and wonderful New Year.